If you're wondering what's ahead for interest rates, today Dr. Andrew Wilson is going to give you his thoughts. And while there have been so many forecasts and predictions, interestingly his have been pretty accurate over the last year if you've been watching our regular Property Insider chats. We're also going to talk about what's happening to the rental markets around Australia. Yes, they're slowing a bit. Is this the end of the rental growth boom? I don't think so, and you'll find out why. We'll also explain what's happening to the auction markets. If you want to keep up to date with Australia's housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. It was only a couple of months ago that most economists were certain the Reserve Bank would cut interest rates in February 2025 at the latest. Now most are suggesting the first rate cut won't come until May or even later. Last week, the latest monthly CPI indicator was released, showing headline inflation had remained steady at an annual 2.1% for October. This was close to the bottom of the RBA's target range, and the data heavily was skewed this time around, though, to the government's temporary energy relief bill rebates. And of course, I guess the RBA would have probably been comfortable or happy about that, but the bank's preferred measure of inflation, trimmed mean or underlying inflation, actually rose from 3.2 to 3.5. So a rate cut early next year is off the cards. I'm looking forward to hearing Dr. Andrew Wilson's thoughts about these latest inflation figures for the month of October, and also his take on the latest My Housing Market rental data for around Australia. Hi, Andrew.
Yeah, good day, Michael. And I guess no surprise to regular viewers here, we've been scoffing at a lot of those forecasts in regard to inflation, which have, really begun more than a year ago that we'd see a rate cut sooner rather than later. And I don't know what these forecasters look at as their information sources, but certainly the Reserve Bank hasn't changed its stance at all, despite headline inflation, as you said, falling sharply over recent months. And before that, it had started to ease, mostly on the back of lower oil prices. Underlying inflation has remained stubbornly high, well above the target range. And yet we get these constant predictions, and from those that, really should be able to produce a more credible forecast, such as the banks. And they change like the wind, Michael, from month to month. And to me, it's a little embarrassing that these entities, such as banks that have large economic departments, should get it so wrong so consistently, given it's their main focus for their business models, interest rates. And one needs to sort of question, what's the agenda here? Is it incompetence, or is it just part of their marketing strategies to try to talk interest rates down? But the Reserve Bank has not wavered in terms of its pronouncements, and that's what we can sort of listen to and be guided by, because it's a Reserve Bank that controls interest rates. And I thought that, a little cynically, I noticed the banks have reduced their deposit rates, their longer term deposit rates. Annual term deposit rates have fallen. Maybe they're anticipating that there would be a cut, so they were sort of believing their own nonsense in a way. But that's not good for the consumer, where we still have the Reserve Bank telling us that interest rates won't be lower, or certainly inflation won't move consistently into the target range till 2026. And yet those that rely on, fixed incomes from interest rates are now getting less of a return, based on, these erroneous predictions from the banks, which are quite consistent. As I've said, for quite a time now, I think we need a little bit of insight into the bank's policies. They have significant market power, which is a good thing because they don't have to take risks with their business models. But I think we need to see the consumer protected from this sort of gouging that seems to be going on with the bank. So, yeah, no surprise. We've got a change in the predictions for interest rates. We've said that this would happen. As I said, it's almost laughable, that we have to keep saying, what are these predictions based on? And as reliable as anything, you can see them changing from month to month. But the inflation data was instructive, Michael. As you mentioned, we saw headline inflation at another low, 2.1% over October. Of course, this is the monthly the monthly data set, which has been introduced recently because there was some criticism that Australia, unlike a number of other advanced economies, was relying on a quarterly data set, not a monthly data set. But the Reserve Bank has quite clearly said that it is the quarterly data set that it will be guided by. The next quarterly data set, which will be for the December quarter, will be released late January. And that's just before, obviously, the first meeting of 2025 by the Reserve Bank in February. But these are, for those that are looking for lower interest rates and aren't just trying to talk them down, this is the results we had were quite sobering. So even though the annual headline rate was steady at a very low 2.1%, the underlying inflation rate, Michael, which you mentioned, is measured by the trim mean, which takes out the volatile elements such as fuel. It actually increased, so it went in the wrong direction for interest rate relief, up from 3.2% to 3.5%, which the target range for the Reserve Bank for underlying inflation, quarterly underlying inflation, is 2 to 3%. The Reserve Bank has clearly and consistently stated that it needs to see inflation, underlying inflation, as measured over the quarters, to be sustainably within the midpoint of the target range. So that suggests 2.5%. On the monthly basis, we're at 3.5%, which, given this is a less volatile measure than the headline rate, is really a long, long way away at 3.5% from 2.5%, even as a single measure. And the Reserve Bank has said it needs some consistency there. So we would suggest at least 2 or 3 quarters in the target range. So you can see why they're saying they don't believe that's going to happen until 2026. Nothing's changed in the commentary from the Reserve Bank. And this, to me, is just, obviously the media are attracted to clickbait, which any interest rate move story is fertile ground for clickbait. But as I said, you'd think those that, present themselves of having a credible footprint in terms of the narrative on the economy and the housing market would be listening to the Reserve Bank. And as I said, I just shake my head, particularly given that banks have reduced those deposit rates for longer term interest rates. But when we look at the fall in the headline rate, no surprise, again, it was driven downwards by a sharp fall in fuel costs. We know that fuel costs have fallen rapidly through the post-COVID period. They were down by 11.5% over the year to October. Not quite the same fall as the year to September. This is the monthly data, which was down by 14%. But electricity costs have really been the driver of the collapse in headline inflation. Electricity was down a record 35.6%. So the cost of electricity, yeah, that's quite amazing, isn't it, Michael? And that's an all-time record. That's how much lower electricity costs were compared to October last year, 35% lower. And that was even lower than the previous month. The September annual fall was 26.1%. And as you mentioned, Michael, that is due clearly to the government's subsidy. And this is what it was designed to do, was to take pressure off interest rates. Treasury and the government had decided to provide this stimulus. Of course, it would be welcomed by consumers that have been, pushed from pillar to post with the highest inflation since the early 70s. But I think the underlying agenda from the government and Treasury was to get inflation down into the target range and therefore initiate an interest rate cut. But of course, it hasn't had the same effect on underlying inflation as it has on headline inflation. So, without wanting to labour the point, the issue still remains that we're a long way from consistently meeting the RBA's target range for underlying inflation, and therefore, we're a long way, unfortunately, for those looking for relief from higher mortgage rates from an interest rate cut. So, and as I said, one of the other drivers has been the reduction in fuel. We can see that really fuel, the decreases in the price of fuel, when we look at the international price of fuel, has really tracked the decreases in inflation, and that's the same for other advanced economies that have taken advantage in terms of lower inflation from the fall in fuel costs. So we need to watch the fall in fuel costs, and we can actually forecast that, Michael, because we know, because the monthly data comes out a month later than the actual data. We can see what's happened to the price of oil over the past month, over November, and it's down again under $70 US barrel over the month. So we would expect to see another easing in inflation, Michael, as we track the price of oil. And there's no doubt that, when we look at the long-term price of oil as measured by US dollar per barrel metrics, that we've seen that decline, and that's been part of the easing, the behind the scene factors for the easing in inflation, significant factor, and consumers would know that when they look at the price of petrol at the Bowser, where in some places here in Melbourne you can see it at around about $1.50 per litre, which is around about $1 lower than what we had a year ago. So a significant factor, and likely to continue to push inflation down. And even though we're focusing on the underlying inflation rate, because we're looking in terms of particularly the housing market on the impact on interest rates, it is good news for consumers that inflation is falling, that they've got relief from major parts of their budget, which is petrol and electricity. So going forward, that's good news overall, that we've got a lower inflation rate and taking some pressure off the cost burdens. As I said, highest inflation we've had since the early 70s. And maybe we could ask the question, did the Reserve Bank ever need to raise interest rates, Michael? They could have just waited for the price of oil to fall away and just given the handout to households for electricity, and we could have kept our interest rates a lot lower. But that's a theoretical question, and because that they don't have the knowledge of what's to happen in the future. It's perfect hindsight. And look, I tell you what else is interesting is there's a number of commentators that are now saying, well, maybe we should be looking at headline inflation, not underlying inflation as the measure, because headline inflation is what affects us on a day-to-day basis, whereas underlying inflation is about the underlying effects on the economy. And of course, the Reserve Bank has to take note not of the less volatile elements of inflation when it's setting its interest rate policies, because we don't want interest rates going up and down on a monthly basis, just responding to the volatility of headline inflation. But I hope we have put that to bed again in terms of the outlook for interest rates. And in terms of the housing market, just to finish, Michael, there's a school of thought that interest rate moves, great for relief. Everybody wants to have a lower interest rate, but it does cause those disruptions to housing markets. As we know, it generates the cycle, changes in interest rates. So, for a while, and maybe with flat interest rates in prospect for next year, we'll actually see an easing in house price growth overall, as it becomes more about the local factors driving housing markets rather than the global drive of interest rate changes.
Well, talking about the housing markets, only last week you released the latest My Housing Market data for the month of November, and the market's lifted up a little bit. Let's talk about rentals this time, though, Andrew. How are the rental markets performing around Australia?
Well, when we look at trends over the last few months, Michael, there's no doubt that rental markets have eased, and we're continuing to see that over November. I think there's a couple of factors behind that. I think that consumers are starting to make choices, reflecting how tight rental markets have been. Prospective tenants are staying at home longer, perhaps. There's a change in the choices of properties. People are looking for or perhaps sharing their tenancies with siblings or friends. They're looking at different property types, more affordable property types, sharing bedrooms, or looking for outer suburban areas or even regional areas. And so therefore on the demand side, that's had an impact on our rental markets. And of course, affordability issues in terms of higher rents. People can't just
Sure.
keep paying, 10% plus per annum higher rents because, incomes aren't rising anymore at that rate. So affordability barriers are keeping some tenants out of the market and forcing those sort of social change choices. So you have to wait for incomes to catch up to rents. And of course, the government's policy to restrict student entries, international student entries, which is a big part, particularly in the big university capitals and a big part of the unit rental market typically. So those factors have it's sort of less demand rather than more supply, although with less demand you get more supply, that have affected the rental markets over recent months, which is sort of good news for tenants, Michael. But generally, and with some exceptions, it's still a tight rental market. Rents are still high. Vacancy rates are still well in favour of landlords. There's plenty of competition for available rental stock. And maybe only a matter of time before rents start to increase again. But I'm sure, policymakers are relieved to see that the headlines rental crisis isn't quite as pointed as it certainly was and should have been over the past year or so. So when we look at the actual data over November, we saw vacancy rates again rising for both houses and units generally compared to the previous month. But rental growth was reasonably flat with some exceptions. And as I said, that there's certainly been an improved market for tenants compared to earlier in the year, but it still remains very much, rental markets remain overall very much in favour of landlords. Still solid competition for available homes that remain in short supply. So when we look at the data for the month of November compared to the previous month, mostly flat results for rental growth. Sydney remains the most affordable, the most expensive capital city market for rentals for houses, steady at $800 a week. Some easing in Melbourne there, under $600 now at $598 a week asking rents. Also some easing in Brisbane, but Adelaide was higher by 1.7%. Perth was flat, Hobart up 1.8%. Darwin down 3.3%. That's a volatile market because of lower activity levels, and Canberra up 1.5%. But when we look at the year's results, it's been Adelaide and Perth as usual that have led the charge in terms of rental growth for houses. Also Sydney up around 7%. Melbourne also up 4.8%. But the vacancy rate data, even though there's some steady news there for rents overall, vacancy rates are still just above or just below 1%, with the exception of Canberra at 1.8%. And even at 1.8%, that's still a market that is in favour of more competition for property for house rentals, and therefore offering more choices for the landlords amongst tenants, and still upward pressure on rents. And you can see the change overall. We're continuing to see, even though those vacancy rates are still tight, that the trend is upwards. Similar results for units, Michael, reasonably flat over the month. Sydney unit rents were down by 0.8%, still the most expensive at $730 a week, and Perth unit rents up by 1.8%. The rest were reasonably modest. Canberra unit rents up 2.3% also over the month. The annual results, again, Adelaide and Perth leading the charge, up by nearly 10% each, but Sydney unit rents have actually fallen by 2.7% over the year. Now, vacancy rates are higher for units compared to houses, and there are a couple of outliers there. Vacancy rates in Melbourne up by 3.1% in the unit market. I think that's part of that less demand from students in those student-orientated inner suburbs of Melbourne. But overall, the trend remains similar to houses, upwards for vacancy rates. So some better news there in terms of a more balanced market for unit rentals compared to houses.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, we're getting close to the end of the year now. There's still auctions occurring. Very few new properties are coming on the market. How did the auction results pan out over the weekend, Andrew?
Well, I've only got 2 weekends to go, Michael, 2 weeks to go with auction results. We're still producing some quite reasonable results given it's the end of the year. We have fewer buyers, of course, because, a lot of buyers have concluded their agenda for securing property. More supply, less demand. That puts downward pressure on clearance rates, which have only really eased marginally over recent weeks. So it's a very similar market to a year ago, and it does act despite the cycle, the seasonal effects. But clearance rates were reasonably steady compared to the previous weeks, even though they've been a previous week, even though they've eased slightly over the last month or so. But that's the seasonal effect, Michael. Similar auction numbers in Sydney over the week, 1345. Clearance rate was again very similar, 68% clearance rate, which isn't too far away from where it was a year ago at 69.6%, Michael. But the auction numbers, as we've seen all year, were significantly higher compared to the same period last year. Big rise in Melbourne auctions, 1,567 auctions over the week. That's a big number, Michael. And the clearance rate actually increased up to 64.1%. So reasonably balanced market there. But, I think that's a positive result given that surge in auctions we've seen. And again, the auction clearance rate in Melbourne, not too far away from where it was a year ago, despite the fact that, there are hundreds of more listings, auction listings compared to the same period last year. Brisbane auction numbers down a little bit. The Brisbane auction market has run out of puff to some degree over the past month or so, but we don't get too concerned about Brisbane. As we saw with last week's house price report, Brisbane house prices are still rising strongly, but their auction market has a bit of a different culture compared to the other, more pure auction market activities in the other capital cities, but nonetheless, a lower clearance rate and lower than where it was a year ago in Brisbane. Adelaide has significantly fallen away from its performance, its significantly higher performances earlier this year when we were typically seeing 80% plus clearance rates on a week-by-week basis. So some easing in the cycle in Adelaide. But again, we're still seeing prices rise in Adelaide, but perhaps not quite as strong as they have previously. And the Canberra market continues to bounce around and a 55.7% clearance rate. And listing numbers and the clearance rate was higher than a year ago. But in terms of comparisons with other capital cities, the Canberra market has certainly been subdued. When we look at the trends, the Sydney market has tracked similarly over the last 2 months in the mid-60s, but well below where it was for most of the year prior to that. But we're seeing an interesting revival in the Sydney market, Michael, in terms of higher priced inner suburban areas such as Northern Beaches. Well, that's not so much inner suburban, but certainly prestige area. Upper North Shore, lower North Shore and the eastern suburbs, they're producing some very strong auction results at the moment. In fact, the top sale in Sydney this last week was a $26 million property in Vaucluse, Michael. So that's a big sale, in anybody's language, of course, even Sydney. So upper price property is certainly finding plenty of buyers at the end of the season in Sydney, which is helping to keep prices growth ticking over. Melbourne, really the same old in Melbourne for most of the year, mid-60s clearance rates, Michael. Again, it's the reverse of Sydney, and the suburban properties in Melbourne are struggling to find buyers generally, whereas mid-priced and lower-priced properties are still behaving quite well in terms of prices growth and higher clearance rates. As I said, Brisbane's fallen away over recent months, more of a typical Brisbane clearance rate we're seeing there, but nothing really reflecting in terms of, as we see typically in terms of the general housing market there, which remains quite strong. And of course, the Brisbane market, the Adelaide market is well below, as I said. It's significant results in earlier this year, which were up above or pushing towards the 80% mark. And Canberra really has a flattish year so far, Canberra, and still struggling to revive, particularly in relation to what's happened in its near neighbour, the Sydney market. If you're looking for those auction clearance rate results, on my LinkedIn channel every Saturday night for the headline results at around 6 to 6:30, and Michael publishes the full national report on Sundays, which includes the regional breakdowns for Sydney and Melbourne, as well as the top 10 sales for each of the capital cities. So that's it for this week, Michael.
Well, it's almost the end of the year, but there'll still be news each week. So we look forward to catching up with you in a week's time to see what happens in the news, to give us some clues to what's ahead.
Thank you, Michael.